AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendes and Gordon Hinds. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendes and Gordon Hinds.
Welcome into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
Thanks for being with us today. Of course, this is a Real Estate Report. It's a show about real estate and mortgages. I hope this is your best second opinion in real estate and mortgages you can get. If not, your best first opinion. We're here to empower you through information, education, and participation, make sound decisions in real estate. That's what we are here to do. This is Drive Time.
Drive Time Special from 6 to 7, I call it.
And it is a live show, 800-516-1220, 800-516-1220. And we appreciate all the calls and emails that we get. We do have a good email from, I think it's Tim in San Rafael. We're going to get to that. But a little bit of the show, we're going to talk about pending home sales, some disappointing numbers.
A lot of changes coming up.
There's a report from the Urban Institute. I like hitting those kinds of reports because it kind of gives us a pulse of what's going on in the nation. And a little bit more. Freddie Mac weekly survey. 30-year fixed 3.88, 15-year at 3.17, and the 5-year ARM at 3.17. The reason I mention these times because you may see a lot of articles right now about interest rates being at yearly lows. But today we took a big hit. And there's some indications that we might see some interest rates go up a little bit more. And you got to love this headline. It basically, the financial crisis is over based on the stress test. Gordon, you probably saw this, that all 34 banks actually passed the stress test.
I couldn't believe it. I think there's one or two of them that are still struggling. I think Capital One
might be struggling, but they all passed.
And
I think this could be that catalyst. That could be that, we see it for the first time, all 34. And it comes 1 week after the central bankers signal their desire to tighten monetary policy, i.e. raising rates. The ECB said their level of stimulus will be adjusted as the economy improves in Europe. Bank of England said it's close time to nearing, time is nearing to raise interest rates. And Canada, they're reiterating their consideration on raising rates. Yellen said in the last Fed meeting, she emphasized the need for policy normalization, including the continued concentration rate hikes, even stating that she doesn't believe that there will ever be another financial crisis in our lifetime.
Wow, that's an aggressive opinion.
So naturally, we saw banks do very well today. Even as the stock market kind of took a hit, techs in particular. But raising rates or rising rates means that banks are going to do better. They're going to make more money. High interest rates means the economy might be a signal the economy is doing better. Well, that's up for debate depending on who you ask. But can we say that we're better off now? That rates are going to start going up, and how do you think that plays into the real estate market, especially on the news of pending home sales dropping?
The key to any economic engine is stability in banking. If you go back and look at the Great Crash, Depression back in 1930s, total bank failure. So if the banking system failed, that's the backbone of our financial system. Everything kind of collapses thereon. Everything kind of falls apart. So if you go back and look at all the rules and changes that we've made over the last few years, making banks do less riskier things and try to cut back on those profit concepts that we're trying to do to kind of almost like keep up with the Joneses. So as the banks get more stability, if you look over in Spain, and I think two of the largest banks in Spain just kind of merge with each other. The Greek banks that were on the verge of collapsing is now stable. So that's why you're seeing these kind of economic projections come out right now.
It took a bit longer than we thought it would. About 2014, a lot of big banks, Wells Fargo's, the Bank of America's, were predicting interest rates in the 5s. And we're still below 4% right now. I don't really think we're going to go as high as a lot of people think. We might see rates back what we saw in November, just after the election. I think that there's a possibility that we could have some wide range swings in interest rates, but I don't think we're going to hit in the 5s, even though a lot of people say that the United States can handle 5 to 5.5% interest rates.
Well, I mean, it's kind of really hard to change the mentality of the consumers, I find. I mean, we've gotten such accustomed to the low rates, lows in the 3s and the 4%. And I think it'd be a huge, when I say huge, financial burden trying to get those rates back up to that high number. Everything becomes balanced, I always tell people. And once we get accustomed to something, once something gets built into the system, it's kind of really hard to change. So rates will go up. How far? I couldn't tell you. But if I'm a betting man, I'm betting it's not going to go up much more. Between 4.5 and probably 4.75 is probably the basis of what the stability will be at the high end.
You think it's time to say get the low rates while you can, especially if you're looking at a refi?
Well, it always is because, bird in the hand's worth 10 in the bush, as we call it. I can never predict what the market's going to do. I can only kind of base what the market's going to do based upon what it has done in the past. Everything that does go up does come down, of course. And the worse economic news, the lower the rates are, and the best economic news, the higher the rates are. So if I'm using your information you just stated, as everything is moving and all banks are passing the stress test and the economy is functioning on 110 cylinders, then of course rates are going to go up. So now there's an opportunity to take advantage of what the market's giving, which is still low rates. I always tell people, take it while it's here.
Yeah, it's kind of always hard to say something like get them while you can. One of the things we've always talked about our business is that it's always slow when rates stay the same, because when rates are going up, we can say get them while you can. When rates are going down, you can say get the rates while they're going down. It's when they stay steady over a long period of time that you see things like applications, which we'll report later, that applications have dropped significantly over the last several years. And just recently, some of the lowest we've seen in months. Well,
that's what I always predict. The market actually works just like everything else. It works on energy. It's like the mob mentality. So and when you watch rates start to go up, you see the flood of applications come in. When rates are staying steady and plan to go lower, everybody kind of sits on the fence, when it to go lower. If I quote a customer a rate of 3.5% on a 30-year fix, he says, well, Gordon, I want 3%. I'm going to wait. And because of the energy, people always tend to work for energy because we are all creatures of habits.
800-516-1220, 800-516-1220 to get your calls in there, join the conversation, or you can email the show, Tony@BayAreaLoanSource.com. Pending home sales, they continue a slide. National Association of Realtors showed a 0.8 decrease month to month in May and a 1.7 decrease from last May. Lawrence Yoon, the chief economist at the National Association of Realtors, said this third consecutive decline in contract activity implies a possible topping off in sales. Buyer interest is solid, but there's just not enough supply to satisfy demand. Prospective buyers are being sidelined by both limited choices and home prices that are climbing too fast. Home listings are down as well, down 8% from last year. That's a lot. The inventory crisis is worse on the market where the demand is the highest. The number of starter and trade-up homes currently on the market is down 15.6% and 13% respectively compared to a year ago, according to Trulia, and the inventory of premium homes has fallen 3.9%.
Yeah, that's always interesting. Kind of always throws me off. I want to know where are the sellers. We've been talking about this same problem for the last, I think, 18 months. Is low inventory in the market. There's not a lot of homes on the market for sale. So typically, when you have a small amount of inventory, you're going to have multiple offers, which is that, of course, has escalated prices in all areas just about. And I'm just trying to figure out where is the inventory going to come from. Is it going to be new housing? I'm not sure where it's going to come from, but it has to come from somewhere.
I don't think higher interest rates, no matter how high they go, is going to change our inventory levels. I think sellers are just as concerned about rising interest rates than as buyers are, because they have to buy a house somewhere else. Depending on if they're downgrading or moving to a second-tier city. We've talked about these all the time, in the West Coast especially, the Portlands, the Seattles, the Renos, the Sacramentos, Utah's, Phoenix. Where did you just go last week?
I just came back from Albuquerque. That's something that's a great point you just mentioned, because I talk to a lot of sellers and I always say, well, why did you sell? You got like equity. And the common question is, okay, Gordon, where do I go if I sell? What am I do with the money? I'm going to actually lose on the downside, because I'm going into a higher price market for less house. And that's where a lot of people can say, maybe that's why the inventory is so low.
Unless you are a seller that's concerned that higher interest rates could limit the amount of buyers that you can get, maybe also limit the desire and the motivation to buy, especially here in the Bay Area. Meanwhile, you're taking a large equity to a place where home prices are a half or even 1/3 of what they are here, maybe even buy free and clear, not even have to worry about an interest rate. But you still have to worry about the person that's buying your house. How is their affordability look? Are they going to be accustomed to ARMs? And a lot of people might start jumping into ARMs because
that reads right into an article I just read where they said retirees, people that are looking to do reverse mortgages, equity is up 8%, which means that there's a lot of equity now and some of these reverse mortgages are actually capped out. A lot of people don't realize when you do a reverse mortgage, you actually refinance a reverse mortgage. So let's say you take a reverse mortgage 10 years ago, you've taken all the money out, now you can go back and re-amortize that reverse mortgage if it's actually capped out. And what the cure for that is equity. Interesting.
And equity is going to be the cue for a lot of people, but when you start running that scenarios, are people going to start saying, you know what, interest rates are going up, prices are going up in these second tier cities. It might be time for me to get out. So I think we're going to start thinking about this, Gordon, and we're going to start talking about it throughout this year, depending on how things go. But I still believe low inventory is going to be the driving force for home prices here in the Bay Area. It's going to be the driving motivation for buyers, especially as rents continue to rise. They're slowing down in a lot of places. But, we ran a comp for a comparison for somebody who's paying $3,300 a month. He's going out to Discovery Bay and his payment's $3,600 after all of his tax advantage, his interest deduction, his principal payment, possible equity growth. He's looking at actually saving money by buying a house using a VA loan, zero down.
Assuming he's working from home and have to factor in his transportation costs. So something else.
That's a whole nother. I tried to do that story one time, Gordon. And I spend $400 in gas. What does that equal on a mortgage? It equals a lot. That's about $100,000.
Especially where gas prices are today.
And then the time that you spend in the car and the depreciation on your car and the miles, it's just, it adds up. And that's just the compromise portion of buying a house that's somewhere farther away. But we're in a different kind of economy now where a lot more people can work from home. A lot more people can drive to work one day a week or maybe once a month. We worked with a client not too long ago who moved up to Tahoe and he drives down 4 times a month. And drives back 4 times.
A lot of people in our business, a lot of loan officers now work from home, so they don't need to come in the office with technology right at their fingertips, faxes, emails, computers, everything else. So a lot of people now are mobile. It's like mobile banking. It's mobile everything. So it's just a sign of the times, I think, as the economy changes, and so does the world, and so do we. And our business has to kind of evaporate into the current system, and we just have to change along with the changes.
It's a town near Auburn, where I was talking to an old client. I said, who lives there now? He says, retirees and remote employees.
Interesting.
And he said that he can't find any places to rent, and the home prices are rising, double digits every year. And I think we're going to see that more and more often in the outskirts of California.
Yeah, absolutely.
Always call the show if you have any questions. 800-516-1220, 800-516-1220. I want to remind you of a seminar coming up. It's a Rob Black seminar. It's called The Retirement Income Strategies and Estate Planning. It's in Burlingame. It's on a Thursday from 11 to 1 p.m. It's a fantastic seminar. We love these types of seminars. I will be there. Lunch will be served. You can sign up at robblack.com, robblack.com. Don't forget, you go to our website as well.
Can I come just for the free lunch?
It's not free.
Okay.
But if you use the special promotion code, I think it's Radio 25.
Radio 25.
I think it's Radio 25. You may be able to get in for free. We'll come back after this break here on AM 1220. This is Tony Mendes
and Gordon Hinds.
The Real Estate Report here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
Thanks for being with us today. I forgot to mention WinNat seminar. It's on July 13th. It's coming up in a couple weeks. In fact, you'll have to be doing the show solo.
Time is flying. Do you realize that next week we'll be in the third quarter of 2017?
Yeah.
Most fiscal years for most companies and cities start July 1st, and we're in the third quarter already. Time is clocking.
Urban Institute released their housing finance, what they call Housing Finance at a Glance report. It's from the first quarter, kind of trickled into the second quarter, some of their highlights. Housing affordability Even in the midst of a report about limited inventory and rising home prices, the max qualifying range for a property in the United States using 20% down, median interest rate, and median household income, it still comes in about 10% higher than we are today as the median home price in the United States of $278,000 compared to $311,000 as the max. And they continue to say that even if rates rose to 5.5%, affordability would not exceed the long-term average. I find that encouraging. You may not feel that way here in the Bay Area.
I find that impossible, but I mean, if you take a rate from 4% to 5.25%, 5.5%, that's 1.5% more. Imagine we're already struggling.
18% higher in payment.
We're already struggling with the prices in our area here. Boy, I don't know how good would that be for the area. That's why I always tell you with these statistics, you always got to qualify and quantify them to what part of the country we're in.
It kind of lends to the whole story that, the $311,000, or
where do you find the $311,000 around here?
Not
North
around
Bay,
here.
South Bay, East Bay.
You're not, but it kind of goes back to the story we're talking about people who are going to retire, and they may go, oh, I have a pretty decent tax basis thanks to Prop 13. I may be able to hand this over to my children. Maybe I take some money out before I leave, turn it into a rental, and go and buy a $311,000 property somewhere else. Maybe a state that's lenient on taxes. Maybe it's Oregon, or Arizona,
okay,
or Nevada, and we're seeing this a lot. We just did a loan for somebody who moved from San Jose down to Simi Valley, and they turned easily $1 million house here, bought it for $555,000. Very happy couple. We're seeing that a lot now. California, I think a lot of Californians are going to say we want to stay in California. I know someone in particular who will not leave California no matter what price they're going to get somewhere else. And they want to be there at the beach, and Californians are going to want to do this. So I think affordability is going to push people farther and farther into California.
Well,
Out of the Bay Area.
affordability, I always tell people you have to look at the big picture. Same thing with some of the NBA players that are looking to go for different teams for more money. Sometimes you kind of focus on one thing and lose sight of something else. It's a whole concept here in the Bay Area. It's not just the weather, it's the employment, it's diversity. There's so many great things that we have in our area that's so attractive outside of the downside of a high housing prices. So it's all liberal and it's all beneficial at the end of the day. That's how I see it.
First-time homebuyers was another highlight from the Urban Institute report. Historically, about 40% of all buyers are first-time homebuyers. During the recovery, that dropped about 30 to 35%, which was normal for about a 5-6 year period. But new data is showing that first-time homebuyers are about 47% of all buyers right now. I'm not surprised. Actually, I am a little bit surprised, and you weren't because I asked you this earlier, that 82.4% of first-time homebuyers use an FHA loan. Now, we're certainly not seeing that here.
That's because of 3.5% down. That's the lowest down payment program outside of a VA. Legitimately, you can do 100% financing. That's the least amount of down payments available in the marketplace right now. So that's naturally you're going to find first-time homebuyers that are leveraging. That's because it's tough to save. So the less money required up front is the 3.5% down FHA. Especially with the limits going up to $636,000 in the high-cost area. So that's a heck of a deal.
We don't see a lot of FHA here in the Bay Area, but it is a tremendous type of loan, especially if you have challenged credit. You have certain kind of gifts that you can get, and they have much shorter wait periods for what we call credit events.
Credit blemishes, no doubt.
And we could probably go over this at some point. You're welcome to shoot us an email. FICO scores are down. October, it was 752. Now it's 725. Purchase scores only dropped 4% in the last 6 to 8 months, attributing the decrease to the fact that refinances are drying up and more people who are buying have, we just talked about FHA loans being a majority, and FHA loans kind of go hand in hand with lower credit scores. So, I still think it's important you look at credit. We're going to talk after we come back from the break why, and this is an email from Tim. He wants to know why there's a big difference between his Credit Karma score and his FICO score. And
that's the question I always ask. Every different institute is offering you credit scores now. If you got to look at it, say, wow, these credit scores have a vast disparity, and you wonder why. We're going
to talk about that when we come back because we have the answer for that. You can always call the show 800-516-1220. Email the show Tony@BayAreaLoanSource.com. You can always visit our website BayAreaLoanSource.com. We'll come back right after this break. I'm Tony Mendes,
and I'm Gordon Hinds.
This is the Real Estate Report on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Passing the covers, kicking back in the sand in the sun.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hinds.
You can always call the show, 800-516-1220, 800-516-1220. Email the show, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. We got an email from Tim in San Rafael. Tim wants to know why there's a big difference between his Credit Karma score and his FICO score. Plain and simple, they use two different scoring systems. One's called Vantage, the other one's called Fair Isaac or FICO. And they weigh things a bit differently, and neither's more accurate than the other. It depends on who's using it. Most mortgage companies are going to use FICO to make their price determinations, and it's more popular.
That's something I discovered. I had to ask myself the same thing because my credit card company, the banks now offer free credit scores online, especially if you're doing online banking. And I'm looking at, I've got Discover Card, I'm looking at Chase, and I'm also looking at my mortgage coupons. And I'm saying, wow, how can the credit score be the same and differ all at the same time and date?
Yeah, so, I'm not saying anything bad about Credit Karma. I like it. I use it. My score, is a little bit different. But what it does do is it keeps me involved with my credit. It tells me if anybody's it tells me if I made a late payment, which that's like the last thing I want to see. But it also tells me if somebody else is running my credit somewhere else. And I know people for a fact who have had alerts pop up and say, are you getting your credit run? And, they can immediately get that thing fixed. I know somebody had a dealership somebody was trying to buy a car at several dealerships, in fact. And it gives you a general understanding of the way, how things work. And, how much does my payment history weigh and how much does new credit weigh and how much do my balances actually weigh for like a credit card balance? If you have a $5,000 credit limit and you have a $5,000 balance, your credit score is going to hit. And if you have 5 of those same kind of situations, your credit score is going to hit 5 times worse.
Yeah. Outside of the credit scoring model, I think it's a good tool for, like you said, managing credit because it tells you what your actual balances are, what your payments are. If you're behind on a payment, if a collection that you didn't know about pop up on your credit report. So it's kind of a good monitoring system that we all need to pay attention to because I tell people in today's world sometimes credit is more important than money. The better credit you have, the more options you have, the less it's going to cost you. If you have a lot of money, you're going to pay for it if your credit is challenged.
We had a 680 credit score the other day because somebody had a $1.93 collection from a medical bill.
Yeah.
And it's really sad to see that because that is going to cost them money in the long run, a lot more money than $1.93. But there's some changes coming up.
Yeah. Speaking of credit, actually July 10th, next week, new law comes into effect. Tax liens, judgments will be removed from your credit report per this new federal law. The federal law is based on what they call an enhanced scoring model. So before these things are placed on your credit report, tax liens, judgments, they have to be verified. Somebody just can't file it and they post it in your credit report. And if they can't be verified, they must be removed. So that's a great thing as far as credit scoring is concerned because all these things does affect credit score. Judgments, tax liens, collections, charge-offs, all these things affect credit.
Is that going to be retro?
It's supposed to go back, but I think the consumer is going to have to challenge it and then send a note to the credit company to validate that these things are actually enhanced. That's the term I read, and that's the term it looks like
we'll do some more research on this. And so if you're welcome to send us an email, we'll get some more information on that as it starts popping up. It might take, just like anything that comes out of the government, it might take some time before it actually works. But it's good to see that those regulations are now being changed because a lot of people have had some, especially if you've had some sort of credit issues, you're going to have some complaints about how their credit score systems work.
Well, it's important. The reason why I find this is extremely important is because, believe it or not, credit scoring is so important. I mean, there's so much emphasis now that we actually look at credit score without even looking at credit. Sometimes I can see a person with credit that is challenged to have a high score. For a lot of the jumbo loans that we do, the minimum credit score is 720. If you get a 719, you can't say, Gordon, I just missed it by 1 point. You just don't qualify. We got to find a way to get your credit score up at least 1 point in order for you to qualify for that program. So the emphasis now on credit score, which is supposed to be the fairest way to look at credit, that's the reason why these things are important that we pay attention to.
Yeah, I think we actually did 700, and some jumbo lenders are even 680. but they
price
you. Yeah, they hit you with price and rate. With that said, we'll come back after this break. You're also welcome to shoot us an email, Tony@BayAreaLoanSource.com. Tim, thank you for the email. And we'll be right back. This is Tony Mendes and Gordon Hinds with the Real Estate Report here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Cause you can, and you don't stop. Cause you can, and you don't stop. Oh, when you can, and you don't stop. Might be coming out for sure, I got the brand new juice, guaranteed like you.
Welcome back into the Real Estate Report.
Gordon Hinds.
I'm Tony Mendes. 800-516-1220. Get your calls on the air. 800-516-1220. I think I might buy a property this weekend. Everybody will be out, on a boat or Tahoe and I'm going to be looking at some real estate. What do you think about people taking advantage of holidays to, while everybody else is taking a vacation? Do you think that's a good time to buy?
Not only holidays, the summer is a great time to buy a property. A lot of people are on vacation. And we just came off the spring buying season, and the great time I tell people, if you're in the housing crunch, you've been being outpriced and outsold, don't get compromised. Now's a good time to continue to look.
Discouraged
now in the summer. You'll be surprised what options you have. Holidays are always a good time. While everybody's out there celebrating with fireworks, you're out there shopping for a home. Great idea.
So wish me luck. I think I'll find something. It's for a cash flow property. I think I'm on a plan where I'm going to add one every 2 years for the next 10 years. I think that's my plan.
You'll be a mogul before you think about it.
A what?
Mogul.
A mogul.
Mogul before you think about it.
Mortgage activity is slow, significantly, according to the MBA, the Mortgage Bankers Association, dropping 6.2% even during some of the lowest rates we've seen this year. Does it concern you, Gordon, that activity is slowing at this time of the year, and kind of throw in the fact that equities are up as well, and there's still such a high demand for housing?
Well, no. If you go back to the calendar, summer time is always a little bit slower. So the market applications do slow down during the summer because a lot of times people have different thoughts or processes on their mind. Well, like I said earlier, we just came off the big spring buying season. Of course, we have limited inventory, so our market is going to be a little bit slower than normal. But I think it's a healthy market. I think there's plenty of opportunity out there for it to recover. So I'm not too concerned about it because it's a good concern.
We just kind of talked about the summer kind of being a slower season for sales, but I don't think it can get any slower or faster than what it is right now. But if you're a buyer, I'd start early. Get that application there. It rarely costs you anything. You have to be careful. I personally do not like lenders that at the end when they do all their disclosures that really fast like that, and somewhere in there it says application fee may apply. Or it does apply. I heard one the other day. I don't like those. I don't like the fact that you go into a broker or a lender and they say, well, $495 application fee. This will be refunded when you do a transaction. It ties you in. It gets you. It eliminates your ability to go shopping. That's like going and signing a.
But that's the whole idea.
Of course.
They want to stop you from shopping. And the average consumer, once they give money, they kind of stop shopping because they feel they're actually committed to that particular circumstance. So that's the whole concept behind it. Like you said, I don't like it. You got to be real careful. I tell people. Matter of fact, I was talking to Linda this week that wanted to have a non-refundable fee. I said, now you're getting into an advanced fee disclosure. I don't think any fee in our business is actually non-refundable unless you perform a service for it. So you got to be really careful when you start winding those lines of collecting monies without representation for clients.
So I don't know if that scares anybody out there from doing their application. We don't charge. We definitely do quite a bit of research before we, push out a pre-approval. Depending on the scenario, we can generally get out what they call an automated underwriting decision, or an AUS or a DULP. It doesn't matter what you call it. It's all lingo for our business. We can get out a automated decision to you within, minutes practically, after running your credit report. But sometimes it comes down to just more than just your, I made $150,000 in 2015. I made $120,000 in 2016. It's a lot of it has to do with what we call your, your two-year history. And a lot of people are self-employed, or part-time. And, they're hopping from one short-term contract project to another, or they rely on freelance work as opposed to maybe a permanent job, and they don't quite fit into that typical package that a lender's looking at. And historically, the mortgage industry wants pretty much everything, like that residency, credit score, and 2 years history of employment. But that's not always true. You'd be surprised out there, people who are listening that have tried to get a mortgage, that lenders are really loosening up on this if you can create the right story for them. And I kind of put together some of the top 6 things that you want to do if you are that type of employee. We just ran into a client that had how many W-2s, Gordon?
I think 30 W-2s.
30 W-2s in the last 2 years. And it's been a nightmare for the lender. And you can help. I mean, the first thing you want to do is get organized. Organize all of your documentation, including the proof of employment, names, phone numbers, have all your records and have all the dates where you've worked. I'm still surprised how many people contact us and they don't give us their full employment. Then you find out later there's large gaps where they've changed their actual career. They've changed line of work. And gather this information. It's important for, this type of environment with lending. And number 2, go the extra mile to educate your lender about what you do, what your job entails. You need to prove that your past 2 years are normal. And I think that's important too, that this is a normal, I may be switching around jobs, but this is normal for what I do. That I think has more weight than, say, I took a month off and went back to work. I took another month off, went back to work. You could say this is normal.
Well, that's why it's very important that you get with a lender that has advanced knowledge of income diagnostics, I think. Mm-hmm. We see all different types of borrowers. We see all different types of industry. There's seasonal workers. There's all types of different things. There are people that switch jobs every 3 years or headhunter business that is just a nature of the business. Property management is one of those jobs where people move from company to company. And so as long as it's all in the same line of work and we can actually qualify and quantify and document what you have done in the last 2 years, we don't seem to have a problem with those type of applicants whatsoever.
You want to, number 3, ease up on the deductions. We've talked about this quite often, especially near tax time. Self-employed individuals often use the Schedule C when filing their taxes to report. They do numerous write-offs. The downside of deductions is these expenses come right off your income. Let's say you made $100,000 and you had $45,000 in write-offs and zero depreciation. That's $55,000, not $100,000. So you have to be really careful about that. Use caution on what you're deducting. It's tempting to use these IRS laws to save some money on your taxes. Number 4, and I'm kind of squeezing this in here at the last minute, talk first with your mortgage officer before you start setting your goals. You kind of want to fit that into what you're doing. Hey, I'm changing a job. Does that make sense? I'm moving to a new company over here. Is that too far away from the house I want to buy or where I live now? Those kind of things really play into the way that lenders look at your scenario.
Yeah, it's always important that we kind of pay attention to what we do and just kind of, don't let me find out halfway into the application process what you have or haven't done. Like sometimes people go out and buy cars in the middle of the transaction thinking the transaction's over. So just kind of keep us informed. We're here to help. We're on your side, and we're going to help you get the approval and get you to close that transaction. That's our job.
Shoot us an email if you have any questions, Tony@BayAreaLoanSource.com. You can always call the show, 800-516-1220. We'll be right back after this break here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I am Tony Mendes.
And I'm Gordon Hinds.
You can always call the show, 800-516-1220, or visit our website, BayAreaLoanSource.com. Been around for a while. This is our 6th year on the radio.
Wow. Time is clocking, as I said earlier.
7 years coming up soon, or the 7th year. Freddie Mac, they came out with their 2017 outlook. May marked the 80th consecutive month of job gains, like that one. In April, the housing starts fell 2.6%, and permits for single-family houses also declined. Average mortgage rates have declined more than they have risen in a few weeks. However, they are almost 50 basis points higher than they were last year. Strong demand and short supply of housing in many markets continue to push home prices higher. Expect house prices appreciation to be over 5% for 2017. And in the first quarter of 2017, the homeownership rate was 63.6%, 6 percentage points lower than its peak in 2004 when it reached an all-time high of 69.2. After a strong March, the housing market from housing starts to new and existing home sales took a hit in April.
Well, another important thing that you didn't mention that Freddie Mac has recently reintroduced, we had it and went away a few years ago. They're back with the automated appraisals, where once you run the DU search engine, you get what they call an appraisal waiver, where we actually don't have to do an appraisal, which is a great savings of time and money, especially if you're trying to do a purchase in a short amount of time. You don't have to wait that long concept of wait for an appraisal.
And if there's something wrong, I'm going to say it, wrong with your house, try to do an LP. LP means Freddie Mac.
Get the appraisal waiver.
So this day in history, real quick.
Oh, day in history. Always a great day in history. Believe it or not, 1958, Pele won the help Argentina win the world. Brazil, Argentina, Brazil, South America, helped them win the World Cup. And what the importance of that is, Pele is the guy who actually introduced soccer back to the United States. I think he came in with the New York Cosmos back in 1978, and now look where soccer has gone in the United States. Soccer was a lost sport. So Pele,
those little kickers running around, huh?
Yeah. Katharine Hepburn also died on this day in 1996. So it's another important person in history.
That was 2003.
2003? I've got my dates off. Is that Gone with the Wind? Is that her famous,
No.
What, Katharine Hepburn? What is she? I thought it was Gone with the Wind. No? Well, we'll find,
no.
I have to look it up then, since I'm off on my dates and
I'm sure
times.
there's a baby boomer out there that knows.
Okay. All right.
What else did we have?
Well, mortgage rates, the Feds have raised rates already, twice this year, and I think they got another 2 slated for, I think, the third quarter, which is coming up in, September, the next Fed meeting. I read an article today that it looks like, based on the banking, health of the banks, and we might need to see another rate increase coming September and in the third quarter. And as we talked before, the biggest difference is on those rates. We might not see the immediate impact on the daily rates on buying, but we do see them on credit cards. We do see them in current loans that are already in place. We start to see those
auto loans, equity lines.
Yeah.
There's going to be a transition, call it a gray area, a crossover where
it takes a little bit of time.
Mortgage rates are going to be lower than equity lines.
Yeah.
And a lot of people are going to consider mortgages instead of equity lines to get cash out of their house. And then eventually interest rates will rise for your mortgage and you'll wish you got it. I don't like saying that much, but I just don't like equity lines as much as I used to.
Well, that's when we see people come back and refinancing those loans back into first and second, combine them one-to-one loan because those rates start to go up. So it's a process that I talked earlier. The mortgage industry works on energy. It works on direction, and any direction that it takes us is always a change. But if it stays stagnant and stable, we don't see a lot of good results in the marketplace.
It's a good seminar coming up. It's a Rob Black and a Chad Burton seminar. It's coming up on July 13th. It's a day event, 11 a.m. to 1 p.m. It's at the Doubletree by Hilton in San Francisco Airport area. You can always go to robblack.com to sign up. I will be there. It's a fantastic seminar. I believe you can use Radio 25 to sign up for that. Get them quick while you can.
I'm coming for the free lunch.
We'll be back next week. Thanks for listening. You can always go to our website, BayAreaLoanSource.com. This is Tony Mendes and Gordon Hinds. We're on the Real Estate Report. Reach out to us if you have any questions. We'll come back next week here on AM 1220 KDOW.